You swipe, you walk out, you don't feel poorer, that's the magic. You buy shoes, protein powder, late night food, it's painless. No physical cash leaving your hand, just a beep and you're gone. And that tiny psychological gap, that's where credit cards win. This entire system runs on one core concept: borrow now, pay later with interest. Credit cards aren't evil, they're tools, but they're designed in a very specific way. By the end of this, you'll understand exactly how banks make money off you, what APR really means, why minimum payments exist, and how to use a credit card without becoming the product. Let's break it down. What a credit card actually is. A credit card is not your money. It's a short-term loan. Every time you swipe, the bank pays the merchant for you, then you owe the bank. Simple. You buy $100 worth of stuff. The bank covers it. Now you owe the bank $100. If you pay it back in full by the due date, you usually pay no interest. If you don't, now the meter starts running. Think of it like ordering DoorDash with your friend's card. If you send him the money immediately, cool. If you keep saying, "Bro, I got you next week," eventually he's charging you extra. That extra, that's interest. Okay, now we level up. APR, the big one. APR stands for annual percentage rate. It's the yearly interest rate charged on unpaid balances. If your APR is 20%, that means if you carried a balance for a full year, you'd owe about 20% extra on what you borrowed. Important, it's annual. But interest doesn't wait a year. It's usually calculated daily based on your balance. So if you owe $1,000 and don't pay it off, interest starts stacking. That 20% doesn't sound crazy until you realize many cards are 18%, 22%, sometimes even higher depending on credit and market conditions. Now compare that to savings accounts, which typically pay way less interest than credit cards charge. See the gap? That gap is how banks make money. Cool. Moving on. Minimum payment, the trap. Every month, your statement shows a minimum payment. It might say something like, minimum due, $35. Total balance, $1,200. That minimum is not designed to help you get out of debt. It's designed to keep you in it. When you only pay the minimum, most of that payment goes toward interest first. The actual amount reducing your balance is small, so your debt shrinks very slowly. Example, you buy $1,200 worth of random stuff, shoes, headphones, probably protein powder again. If you only pay the minimum each month, it can take years to clear that balance, depending on the rate and payment structure. And during those years, interest keeps stacking. Minimum payments keep you comfortable. Comfortable debt is profitable debt. Banks don't want you broke, they want you slowly paying. Most credit cards have a grace period. This means if you pay your full statement balance by the due date, you don't pay interest on purchases. 0. This is how disciplined people use credit cards for free rewards. Swipe, track spending, pay full balance every month, no interest. If you always pay in full, the bank doesn't earn interest from you. So how do they still make money? Merchant fees. Every time you swipe, the merchant pays a small percentage to the card network and bank, usually around 1 to 3%, depending on the agreement and region. That's called an interchange fee. So when you buy $100 of food, the restaurant might receive slightly less than $100. That fee gets split between the card network and issuing bank. So even if you pay your balance in full every month, banks still earn from transaction fees. Interest is the big money, but fees are steady money. Okay, now let's talk psychology. Why swiping feels different. Humans feel pain when handing over physical cash. Digital payments reduce that friction. When you swipe, there's no immediate loss sensation. Research in behavioral economics suggests that people often spend more when using cards compared to cash, partly because of this reduced pain of paying. You are more likely to overspend with a card than with cash, which increases the chance you carry a balance, which increases interest. And now the system is working exactly as designed.
designed. Rewards aren't free. Cashback, airline miles, points, sign-up bonuses feels like free money. It's not free. Rewards are funded by a mix of merchant fees and interest from people who carry balances. If you pay your balance in full every month, rewards can be beneficial. If you carry a balance, the interest usually wipes out any rewards you earned. Getting 2% cashback while paying 20% interest is not a win. It's math. Okay, next. Using a credit card affects your credit score. Your credit score is basically a number that tells lenders how risky you are. Two big factors: payment history, do you pay on time, and credit utilization, how much of your available limit you're using. If your card limit is $5,000 and you constantly carry $4,500, that's high utilization. High utilization can lower your score. Lower score equals worse loan terms in the future. Higher interest on car loans, mortgages, personal loans. So credit cards don't just affect today, they affect future borrowing. Why banks love revolvers? People who carry balances month to month are called revolvers. People who pay in full every month are called transactors. Banks make far more money from revolvers. Interest income is huge compared to swipe fees, so the entire system nudges behavior toward spend more, pay less than full, and repeat. It's a business model, not a charity. Let's say you buy $300 of supplements on impulse. You tell yourself you'll pay it off next month. Next month comes. Rent hits, gym membership, streaming subscriptions, food. You pay the minimum. Balance drops slightly. Interest adds slightly. Next month, same story. Now that $300 purchase quietly becomes more expensive over time. Not because protein powder is evil, because carrying debt is expensive. That's the mechanism. How to use credit cards safely. Here's the boring but powerful strategy. Treat it like a debit card. Never spend money you don't already have. Pay the full statement balance every month. Keep utilization moderate. Set autopay for the full balance. That's it. No hacks, no secret tricks, just discipline. If you can't trust yourself to pay in full, debit card is safer. No shame in that. Credit cards are short-term loans. APR is yearly interest on unpaid balances. Interest is calculated regularly, not magically once a year. Minimum payments keep you in debt longer. Grace periods avoid interest if you pay in full. Banks earn from merchant fees and interest. Rewards aren't free if you carry a balance. High utilization can hurt your credit score. Revolvers are more profitable than transactors. Carrying debt makes normal purchases more expensive. Credit cards are powerful tools. Used correctly, they build credit and offer convenience. Used casually, they quietly tax your future. The system isn't evil, it's just math plus psychology. Understand the rules and you win. Ignore them and you fund the rewards for someone else. If this made you rethink how you swipe, drop a comment with the first thing you're cutting from your next statement. And maybe don't let protein powder become a 2-year loan.